Ladies and gentlemen of the crypto space, we're live on a Friday, October 13th at 10:59 a.m. We're here early today because we're here to talk about what everyone wants to talk about. What is the next crypto protocol to buy? And you have to buy it because it's going to go to the moon. It's going to go up 1,000x on the money, and nobody's going to sell it because nobody wants to take profits. It's just going to go up, and it's never going to come down, and it's going to go to the moon. No. Man, could you believe that that was content, or that still is content to a degree, or that was such popular content? People are susceptible to hyperbole, exaggeration, the irrational. I mean, isn't that everything that's going on in the world is completely irrational? It's all about opinion. I like this. I like that. This is better than that. Opinion. In college, I found fascination with, I mentioned Socrates a couple of times, but this is all the ancient philosophers and the concept of objectivity. And it's merely a concept, an idea, because no human could ever perceive something objectively. But I'm fascinated with that. Like, can we look at our entire life as a set of data points and, you know, it's kind of like really Newtonian, and that the future is predictable if you could literally assess the movement of all atoms. You could literally predict what everything's going to be. But humans and our thoughts and our opinions and our emotions, maybe that's not the case. It isn't the case. It can't be the case. But we could try and peer through the bullshit to try and give us some sort of clarity to make complex simple, especially with what's going on. It's so complicated. I don't have time for complicated. I need to keep things simple to maintain my sanity, and that's what I do. Obviously, I'm human, I'm emotional, and I feel these things, but I always go back to my rules, my processes, my capacity to quantify and inspect and try and identify. If I identify an opinion, I can be like, all right, it's an opinion. So what is that opinion talking about to give me hopefully an increasingly objective perspective? Increasingly. It's never going to be an objective perspective, as I started the stream talking about. So where are we? Bitcoin ETF today? Maybe. So there's plenty of interesting things going on financially. The financial system is positioned to crumble, as we have on this chart, is the oil price. Now, oil, when you have global conflict, the 1970s showed us, you get oil disruptions and oil prices go through the roof, and that's relative to demand. 1970s, they jack rates also and collapse credit. And nowadays, credit is obviously completely frozen. So that entails, does demand equal, is demand, can demand be equal to or less than that of supply? Oil up, dollar up, so on and so forth. So there's all these counteracting forces to get a sense of the directionality of markets. You're never really going to know the directionality of a market. You get a sense of it. And I guess this plays into what Shisk is wanting to talk about. Shisk wants to know when to buy. But when to buy needs to be part of your rules. Do you have defined procedures, defined actions to take under certain circumstances? And in many regards, this is like the concept of dollar cost averaging. In my opinion, my rule is I don't necessarily own what I own because of price action. I own it partially because of the elimination of counterparty risk, and I'm paying a premium in volatility to eliminate said counterparty risk. And to me, that's meaningful. So there's plenty of reason for, in my rule book, to own things that are depreciating, to buy things that are depreciating, and to adjust accordingly. And in the first instance, to stop and think is when you feel an emotion. And I often think that with regard to the cash position, cash for me being Bitcoin, Ethereum, and stablecoins and dollars, and a deposit in a financial institution. And I'm like rebalancing. I'm thinking with regard to rebalancing. So this has helped me greatly in navigating this treacherous territory. At least I've compartmentalize the portfolio to such a degree where you have investments and you have cash. So the investments, and that's why I love lock positions so much, because that eliminates an entire component of the portfolio with regard to having to think about choices to make, actions to take. If you can't do anything, it's not something to consider. So all I have to really manage is the cash position. And the cash position is much smaller than the investment position. Um, and I often think about adjusting how much cash, stablecoins versus Bitcoin versus Ethereum, and I got to remember and remind myself of why I owned the Bitcoin and Ethereum. And that is for elimination of counterparty risk, or at least minimization of counterparty risk. And that produces a great deal of comfort for me for a variety of reasons. So why not? You should own, and I should own Bitcoin and Ethereum. So do you think we're getting to the point where buying makes sense? I always have, because I have it for a reason. See, the complexity is portfolio size. Uh, I'm trying to put the words that I say into the perspective of someone that has never invested before. Let's say you have barely saved up $1,000. I myself have had $1,000 in my bank account when I was, younger. Teens and early 20s. I could recall those days. And I'm like, what do I do with my money? Do I buy Bitcoin? What if my Bitcoin goes down? Then I have less money. So that's a very difficult leap. It's a very difficult position to be in when you're just learning these types of ways to think. This is why I've mentioned historically, a person buys dollars, because it's such a counterintuitive way to think. Outside the United States, you don't earn dollars, you don't make dollars, you buy dollars. Just like you buy gold, just like you buy, if you're in Switzerland and you want to buy euros, you got to buy euros with francs, or you got to buy pound with euros, and vice versa. You actually have to buy currency. The dollar outside the U.S. is bought. So part of bias, subjective bias, is the denomination of how you earn from employment. And that's the base case. Most people don't earn from crypto. I mean, can you imagine if you didn't work and you literally just had $100 million worth of curve and you were just literally earning curve? I mean, literally, your income is curved. So if you want dollars, you literally got to buy dollars. So one of the hardest things to do, but it really, I guess maybe it complexifies things, unfortunately, is to unlearn the concept of your base currency. The whole world for the vast majority of the U.S. population is dollars, and dollars is money, and that's it. There's nothing else, and anything else you buy. But that's not real. That's a false reality. That's an illusion. It's fake. The currencies are assets. They're to be bought and sold based on supply and demand. And right now, the supply of dollars has been significantly decreasing. Obviously, disinflationary relative to 2020, but relative to December 21, it's been deflationary, the quantity of dollars in circulation. And if you were able to inspect granularly the Eurodollar system, the supply of overall dollar liabilities has contracted significantly. I mean, not significantly enough to cause systemic disruption like we've seen historically, and that's because of all the liquidity injections. They're counteracting the deflation, making it basically a disinflationary environment. So they're manufacturing this relative soft landing that they've been, they're literally manufacturing the path that they want. Whether they could achieve that or not, we still have yet to see. And what does that mean? So let's say something falls apart bunch of banks fail, a big corporation fails, and the Fed just extends an additional liquidity facility and papers over it. Because you got to remember, the banking system completely collapsed in the United States in March of 2023. That would have been cascading. That would have been contagion. That would have been spreading of fear. And that fear is powerful, and that just fear drags everything down. You know, if all those components of the system started failing, the cascade effect would have been extraordinary. So they have achieved what they wanted to achieve, provide the liquidity where it needs to be provided to prevent disinflation from becoming outright deflation. Anywho, the whole point is to try and peer through the bullshit. So I don't have an answer to that question, or this is still a punt. Yeah, with regard to like investments, with regard to protocols, you call them altcoins, but they're really a digital representation of an enterprise. And does that enterprise make sense in a high interest rate environment? Does that enterprise make sense in a negative sum game? What is the risk profile of that enterprise considering those characteristics of the overall environment in which we are in? And that's why investing is hard in this environment. That's why government bonds crowd out investment, because it is hard for these protocols to grow when it's a negative sum environment. Where's the capital coming from? So obviously in a positive sum environment, the protocol is growing, it's doing well, and that means interest rates are probably lower, and that means you have currency being created. So right now that's not the case. Right now, the safest investment is risk-free. Now, I tweeted earlier this morning, actually, that nobody wants to be left holding dollars when they start cutting rates. Now, if nothing breaks and they start cutting rates to create that soft landing that they're talking about, you know, they cut by, what, a quarter, and do that for like one or two FOMC meetings. Nobody wants to be left holding dollars, but they're decreasing the fear. Oh, nothing broke, and they cut. All right, it's calm, it's smooth, and now people are still waiting. Something can still break because credit is still quite tight, and then they do another 25, and then heading into Q2, Q3, Q4 2024, Q1, Q2 2025. They're off the current FFR by, let's say, 75 points. Nothing still hasn't broken. It's been a year and a half. Now capital is going to start to edge into risk assets that are investments, that are enterprise, and credit's a little bit looser. Cash is a little bit more available. It's more of a positive sum environment, less of a negative sum environment at worst. And that's how a cycle happens. It's a slow, gradual process of people feeling more confident that they can deploy capital and not lose the dollar price point of their allocation. Hope that helps. So there's no simple answer to that question. This is all pretty much trying to give some perspective on how to think about buying and selling, and what Shishka's talking about, what everyone thinks when they're trying to get into the concept of investing. The first stop is to just redefine everything, because you need a different perspective. You need to turn complex into simple. It's the only way to do this. Dan's in the house, a pleasure. Tim, no interest in stuff like that. And I certainly don't consider things that are asked to be considered. I appreciate that. I have one rule. That drives everything for me. You want me to invest in your company? How much are you paying weekly? 0%, but the growth of the crypto asset, the growth of the stock price, and me, fuck you, pay me. That's it. Pay me. I don't give a shit about the pitch. It changes everything. I have one need at the end of the week, and that's how I'm able to quantify how effective an allocation or investment is. It's in my profile. It's the pin tweet. Fuck you, pay me. I don't have time for shit. I don't have time for anything. Pay me. That's how you assess whether an investment works, is good or not. And I think this pinned tweet's going to last a long time. If something is paying now in this type of market and it's deterministic and immutable, it's going to pay in the future. It's immutable. It can't be changed. It's deterministic. It's going to pay weekly. How much? It's going to vary. But how often? Weekly. So I'm not interested in taking a risk right now. Maybe it'll pay in the future. I surely don't give a shit whether it's going to appreciate or not, because I don't want capital gains. I want income, because you could bank on income. You could make choices and decisions based on income. And I'm not a trader. I'm not interested in that kind of market activity. I don't want to be that kind of actor. I don't engage in that kind of behavior. I want an X, Y, Z. How much does it cost? How much is it paying? And how likely is it to continue into the future? So Z, if it's immutable and deterministic and it's currently configured to pay me in this shit environment, that's exactly what I want. So I'm quite content with the portfolio construction as put together in 2022, and I think it'll serve me well heading into 24, 5, and 6. James, ETF on Friday the 13th. How fitting would that be? Right? So, I'm not too fond of being overexcited about the ETFs, and I'm not too fond of just generally, the Bitcoin maximalist narrative or whatnot. Bitcoin's cash. Great. It behaves as a cash. You could use it to pay for things. I don't give a crap about the store of value narrative. What I care about is the reduction of counterparty risk. It's a currency that's portable, cross-border. Pretty much anyone, you could convert it to local settlement currency pretty much anywhere. So that's meaningful, especially as compared to a dollar deposit at a financial institution. Got to go through ACH or a wire, and good luck getting that cross-border. I don't trust that shit at all. Too many counterparties, too much risk. So that'd be very interesting. I do like that. I think that is a popular narrative, and I think that would be quite interesting. They approve one, and then it's just going to be a landslide. So I think there's a lot of catalysts that can trigger significant capital flows. Now, that would be very interesting to see in a decreasing liquidity environment, certainly a negative-sum game, but a catalyst surely can cannibalize a lot of capital that's around no matter what. So you could have credit completely frozen in traditional finance. You could have banks failing. There's still trillions upon trillions upon trillions and trillions and trillions and trillions of dollar liabilities. And those dollar liabilities, we know that capital flows from underperformance to outperformance. And if there's significant outperformance, it's going to draw in capital. It's basically a vampire attack, as we've called it in crypto markets, where everyone piles into the outperformer. So I find that reasonable. I think that makes sense. So there's great potential for that type of scenario to occur. I certainly don't discount it. I don't have hope or look forward to it, but I inspect whether it can occur or not, and it certainly can occur. Sergio's in the house. A pleasure. Drew. Shish, my man. I don't mean to be critical. I just try to be precise and a reductionist, as I said in the tweet, to break things down to the simplest possible ways to think about stuff. Do you think the macro outlook is going to improve from here or continue uncertainty and volatility? Credit's frozen. It's completely frozen, which means the government, the public sector, has crowded out private investment. Now, the rates, if they cut rates, that means credit is expanding, and it takes time. It takes 12 to 18 months for changes in rates to start to create currency units in circulation for credit to print money, for the public, the private sector to print money. So cutting rates doesn't do anything to really resolve the destruction of circulating currency supply that has occurred. Now it'll affect things with narrative. It could affect flows and the flow of capital between markets. So um, I don't think available liquidity improves from here. Uh, it's a disinflationary environment, and that's a manufactured environment because without the liquidity injections globally, it would be an outright deflationary environment, and you'd have many more bankruptcies and contagion and capital destruction all over the place. But that has been suppressed to a great degree. Um, and that's the reality of where we are right now with regard to macroeconomic conditions. So I expect volatility to potentially be extraordinary. Everyone is completely on edge of what's happening with regard to global conflict and the impact on that on energy in particular. I've had oil up this entire time. Now, bear in mind we'll know how much demand destruction and how seriously credit is frozen based on this chart. If credit is completely frozen, if the U.S. consumer is completely tapped out, if global markets are really basically contained with regard to growth, it means global GDP is going to come down over the next couple of years, then oil won't go up too much. Maybe we see a sustained oil price between here and 122, and we follow this trend. But that would be manufactured because if there was freely available credit, freely available cheapness of money, then this goes straight up when you have unlimited demand and a limited supply of resources, Luke Gromen talks about. So this is straight up, and the net result is the dollar going straight up because how else do you finance? I mean, just literally, it's all dollar-denominated debt outside the U.S. That's where the denomination of the vast majority of debt, 106.7. Wild chart. Notice, as I always say, I inspect on the 6-month chart. So the destination is up, but that takes 10, 20, 30 years. Cycles will cycle. Notice, bear in mind, this is the first not gray guppies ever on this chart, which is kind of wild to see. So, and why is it not gray guppies? Because it was gray is neutral, red is depreciative, and then green is obviously trending upward. But this is because this is all a bull market. This is one giant dollar bull market. We zoom out to the 1-year chart on the dollar, and it's straight up since 2008. It's the same thing from 92 to 02, the dot-com. It's the same from the financial crisis to end of 22 was really when the Fed, end of 21 is when the Fed decided to start to really constrain liquidity, which we had free liquidity all through the 2010s. So it was just cash bonanza, credit bonanza, and we had how much negative yielding global debt there was. It was record negative yielding global debt. It was just monumental. And that's how much dollar-denominated debt was created in the 2010s. Extraordinary. And then all of a sudden, credit tightened, and everyone around the world started tightening credit. Negative yielding debt just basically collapsed. And this is the first site. This is just it. That's it. This is why time horizon is so hard to process for a human, because we're literally sitting here and we're like counting 10, 9, 8 seconds of the day. And meanwhile, this is the cycle. 08 to end of 21, 13 years. Huh. Imagine a being that had a capacity to inspect time from that perspective. Certainly not us, but that's what I like to think about, and that helps. That helps, at least thinking about it. So if they want the system to continue, the death of the dollar is the consumption of all global fiat being absorbed by the dollar, basically to finance the global dollar-denominated debt, or at least to resolve it, to settle it. So the death of the dollar is up here. So if they want the game to continue, the dollar has to come down. And as we've seen with Fed talking points, they've talked they've said, oh, this is probably the last, probably done raising rates. So they're trying to jawbone the dollar down without actually reducing rates. But this is going to be an interesting, probably next 12 to 18 months, because after they stop raising rates, there's still plenty of rate hikes to play out with regard to their effect on the market. I mean, literally, credit's frozen. Retail housing, like first-time home buyers, is completely frozen. This is a pretty sticky time. Hope that helps. Um, Austin, what are we going to do once Noah gets the recognition he deserves and there's 10,000 live streamers and a million questions flowing in the chat? Got to get our questions in now. I mean, I don't know. Listen, I talk a certain way, and I don't think I'll ever be incredibly popular. And I understand that. Friends and family have been telling me that my whole life. Like, just make it simple. And to me, the things that come out of my mouth are simple, but I know this is quite complicated material. We're literally looking at 1-year charts and inspecting 13 years worth of data in 13 candles, and this is complicated, deep stuff. From a Gen Pop perspective, and I appreciate that. So maybe my content won't ever be that popular, but that's okay. The whole point of me doing this is to push people to try and convey a message that's different than, holy shit, it's going to the moon. You're going to turn $1,000 into $1 million, and 98% of people that try and do that lose everything. And this is obviously a sustainable methodology based on rational rules. You know, what's the most rational rule? This is the most rational rule. X, Y, Z. Pay me. Why? Because I want to go to the supermarket and buy cereal for my kids. Or I want to go out to dinner and get some sushi. So pay me. That's why I want you to pay me. So how do I get someone to pay me? Okay, you could spend time on money, and that's employment, which we all know, or I could buy a part of a company and have it pay me. Why? Because that's what a company does. A company generates revenue, and I want that company to pay me that revenue. The problem with equities, they don't pay you shit. The problem with equities is there's humans and boards and real estate, and they pillage the cash flow. And the lovely aspect of crypto is that there's no people, it's just software. There's no real estate, it's just software. There's just cash flow, and then there's the definition of where that cash goes, and that's it. I've never seen anything like it before. So the price action may be scary and worrisome, but this is, if anything's going to work the way I see the world that I want to be in the future, this is it. So this is where I put my chips. This is where I take that speculation that I'm right, because this is the world that I want to be in the future, where I own a company that has no real estate, has no humans, and fuck you, company, it pays me. Why? Because that's the software, and I'm not saying fuck you to a person. I'm not saying fuck you to anyone. The software doesn't have an opinion. The software doesn't get intimidated or insulted. The software is just written, and it's going to pay me no matter what. And I love that. What is your rational opinion on Balancer and its place in DeFi? So the Curve Federation is stronger than ever after the releases of like Prisma and a bunch of others are coming online. I talked about like the 5 or 6 different recycling regimes that are coming online, and that's what you want to see. And obviously, in a positive sum environment, in a capital expanding environment, that's just going to explode. So there's much more strength there. What I would love to see with regard to Aura and Balancer is more recyclers, protocols that are deterministically accumulating the asset, disrupting circulating supply, and that's a big deal. So that's absent, at least to the extent that we have with the Curve Federation. So it's missing something, and I often think about what Tetranode says, like, why do I own that? It does the same thing as Curve, and that's true. But there's very interesting properties with regard to balancer that Curve doesn't have, and Aura is. I have a high opinion of what they're doing. So what does that mean? Is it diversification? Do we need that kind of diversification? The net result of a successful portfolio is not diversification, it's concentration. That's a Warren Buffett mentality and methodology. So, in that regard, maybe it's an incorrect decision to diversify. Um, humans diversify out of fear to reduce risk. And you make the most returns when you concentrate. So I don't have the easy answers to that question, but I hope that helps explain my stance regarding it. I myself have an aura position. It pays me deterministically, which is quite nice. How well will it do in the future? You'll only know that from hindsight. Will it keep paying in the future? Sure. So X, Y, and Z apply, and then, how much is it paying? So it's paying the same way that other things are paying. So it might be unnecessary. I don't know. That's a hard one, and that's one I think we'll continue to struggle with. Hero not paying now, but maybe later. So that's X, Y, Z, and Omega. So Omega is like your speculative investments, speculative cash flow in the future. So obviously we have some speculative investments still on the table. The price action of Hero has been extraordinary. It still elevated. It was 13 cents. That's pretty remarkable considering market conditions. Pretty remarkable considering its Solana protocol. But look at all the protocols building on it. It hits all the characteristics of something I want to own as a base layer maxi, as infrastructure. I just want to own something that everyone's building on. And then when you have a positive sum environment and great liquidity conditions, then you have 1,000 protocols building on top of Curve, on top of Balancer, on top of Hero. And then you don't have to chase 1,000 protocols. You own the protocol that everyone's building on. And that's cool. That's big to me. So I have a good opinion of Hero for what it's worth. It doesn't really pay anything now. I have a relatively large position in it, and it's held up very nicely in price point. I don't know what that means to everyone. Everyone will have a different reception to me saying that, but that is what it is. Raul, hello. Drew, what do you think about Pendle and the projects building on top? It looks like Curve was in early days. Yeah, you could say the same thing about Maverick, and I don't really want to make much speculation right now. Uh, I don't. I know about Pendle. It's a nice product. It has, a retail type of perspective. It's a sellable product. I don't need it. I don't. Therefore, I don't have much interest in it. It will do what it will do, and there will be plenty of things that do well that I don't need to have exposure to, and that's okay, because all I give a shit about is Friday, if it's paying me, and the odds that it will continue to pay into the future. That's why we appreciate you so much, Noah, for the granular and detailed explanations. I have learned so much from you over the years. Cheers. It's much a pleasure. We need to have sustainable storytelling. We need to be consistent. There's no flip-flopping here. All there is rational dialogue about the choices and hard choices we have to make on a daily basis. So let's take a peek. Let's take a peek at Bitcoin. Look at this 12-month chart on Bitcoin. Love this chart. Particularly the 6-month where you have the TWAP. It's never below the TWAP, so we can have a nice retrace to 18,000. So you get a 30% clip. You lose 30%. You know what happens? You know what it takes? Bitcoin to run down to 18,000. You got something crashing significantly. You got significant capital destruction, a lot of fear. A lot of fear because, look, there's like no money in the crypto space. I mean, literally, I'm talking about total crypto market cap. It's like it's $1 trillion. This is nothing on the grand scheme of things. And what they're afraid of is it not being nothing on the grand scheme of things. So when credit is being destroyed and you have bankruptcies and war and complexity, you think about forced selling. Okay, so your Bitcoin loses 30% of its money, and then They don't want the world to end, so they devalue the dollar. You got fiscal spending everywhere. Credit loosens. They drop rates by 2.5%, an emergency 2.5% cut, and the whole world goes wild with regard to liquidity. You have a liquidity bonanza like you had in 2020. They don't want that. They want to keep that liquidity bonanza constrained to the financial economy rather than the real economy. So I don't think it would be down there very long at all. And history says, especially in 2020, it was literally a wick in a 6-month time. If you bought on the 6-month time weighted average price, 6 months later, you were significantly higher than the purchase price. And that's what this trend tells us from a time weighted average price perspective. It doesn't spend much time at all on the time weighted average price. Problem is, this is a relatively short time frame. It's a relatively young asset, so you don't have much history to go on. But we could look at something with a longer history to get a sense of what 6 months means from an average price perspective. So obviously we have 15 years worth of history back to '08 for the time weighted average price. And I wish we had a TWAP back here in like 1980s to 1990s. Let's take a look at, see what kind of data we have. Let's zoom out a bit. All right, we have much more data here. That was obviously futures. You still don't have, yeah, here's the TWAP. It's in here. Let's turn off the guppies. So looking from a 6-month TWAP, wow, we have all our data that we need. So it doesn't, the S&P doesn't spend much time below the time weighted average price, obviously in the 30s. But look at this, from a 6-month perspective. This is what Warren Buffett talks about when he says to buy a cheap fee index fund, because from a 6-month perspective, if you bought the S&P at or below the 6-month TWAP, it was higher 6 months later. Obviously, it took a year back in '75. It took a year back in 1970. Let's not talk about the 30s. It was a different world. It took a couple of years, actually, in '08, '09, all the way into 2010 to get back above the time-weighted average price. It took about 3 years back in the dot-com financial crisis. But after that, it was barely any interaction with the time-weighted average price. So this is the power of the time-weighted average price. 62 was a mean regression. 66 was a mean regression. Look at that. He had a mean regression back in '49. And that's it. So the mean regressions to the average price are historically your time of best opportunity, and obviously time below. Literally, if you look at '09, '08, '09, it was literally a 50 SMA mean regression on the 6-month chart. So mean regression. The mean regressions on the longer time frames give you a great deal of perspective. It's never gone down. It's up only. The whole chart is up only. Do you think we're going to be at 100? And the world's ending. That means there's no companies. If this goes back, a mean regression back to the '70s, there's no companies. There's no investment. If there's no companies, it's the whole system. There's no real world anymore. There's bows and arrows and fighting each other for food and shelter. There's no working. There's no construction. There's no contractors. There's no labor. There's no nothing. It's anarchy and chaos. So, hope that helps. Zoom out. Zoom out. And that means today doesn't mean much with regard to your cash position. You might as well just wait 6 months, wait a year, check back. Raffle, you guys are not on Pulse Chain. Pulse Chain is irrelevant but fun. Oh yeah, Drew. Doesn't really mean it. It's meaningless. I don't want fun. I don't care about fun. I don't have time for fun. I have time for Friday, and I have work. I have my profession, my skill, my career. I have no interest in fun. I don't care what's popular I don't care what's popular with the kids, what's hip. It doesn't mean anything to me. What I care about is where the capital is. That's all that matters. And where is the capital? So the capital is primarily on Ethereum mainnet, $65.32 billion. There's some decent, interesting capital here, $1.6 billion, and Polygon has $1.2 billion, and Solana has $1.5 billion, and Avalanche has $1.2 billion. But those are emerging markets of emerging markets. Optimism has half a bill. So Ethereum it dwarfs them. It's massive. And obviously Ethereum is zero relative to total crypto at a trill, and total crypto at a trill is nothing compared to global macro financial. Kava's 145 mil. That's pretty cool. Do they have? No, they don't even have Pulse Chain. If you go on Deck Screen, you can see what kind of shit show it is over there. Uh, I'm going to humor this narrative for a couple minutes. I just got to find the damn chain. Oh my God. Look at this volatility. Look at this is kid stuff. I mean, this is literally Deck Screener. So this is the top volatility. This is useless. This is no business to be talked about in a serious capital management. This isn't even. This is just. This isn't even kid stuff. This is just downright dangerous. All this is player versus player. Um, you would need to see capital flows, and I'm sure it's all outflows. I'm sure this has already been pillaged by the large actors that have just, you throw. What's 50? You could literally buy these things. You throw around 50 grand and you just own these LP positions, and that drives in capital, that sucks in liquidity, and then you just dump it on their heads. Look at these liquidity. The liquidity is nothing. Don't tempt yourself. This stuff is dangerous. You'll lose your money in a heartbeat because there's people out there that will take your money. I'm the nice guy telling you that I would take your money. So you can imagine the people that don't have the same ethics, morals that I do. They just literally take your money. I'm not even talking about scams. I'm literally talking about just throwing around 50, 100 grand, and you manipulate LPs to draw in capital and you take their money the legitimate way. So that's just the bottom line. No, I'm sitting on my largest war chest of stables ever. I'm trying to balance the need to get the largest discount while not missing a good enough entry. I think we go lower. CVX and CRV on the list. Taking positions is the hardest thing you'll ever do. Once you have positions, especially locked positions, you've eliminated any of the contemplation required to take a position. So you've simplified the equation. And now you have to just deal with the emotions and will it survive? And if you think it'll survive, great. And that helps you reduce the fear and the anxiety. But taking the position is the hardest thing. Once you take the position and it's a purchase rather than a position, you no longer have to contemplate it. So there's a lot of burden and due diligence and energy and effort required to actually take the position. That's the hardest shit there is to do. So I have much sympathy, and I feel, and I listen. Feel for me a little bit because I have to deal with the emotions of significant volatility. But then again, you all do. We all do. But I haven't taken any positions. I haven't done anything in quite some time. I tell you guys on Discord, and what was the last thing we did? I was the convex position. Let's see how convex is doing for the fun of it. Ooh, I don't need that. Convex 262 on the weekly. I don't know. At some point it'll find the low. I would hope around here. Got stopped out by the TWAP on the weekly. I snagged a what, 280 I said, give or take, about 280. So we're at about 260. All right. And what was it before that? It was like I think it was Aura at the beginning of the year or late last year or something like that. So remember what we talked about many streams ago is like you, you only want to do like a couple of things a year. Why? Because that's the ultimate situation where you want to find yourself. It's like, I don't want to be trading. I don't want to be buying and selling. I literally just want to click a button a couple of times a week and get paid. Get paid to go to the supermarket. Money, income, employment. I own shit that pays me. So you really want to find yourself in the coming years, maybe buying things like once or twice or three times a year. I'm just saying, not a specific number. I'm saying you don't really want to do much. You want this shit to just be. It exists. You own things. So, I remember years ago we were just frantic with activity. Like, what do I do? You're overwhelmed. Do I buy this? Do I sell this? Is the price going up? Is the price going down? Not anymore. I ain't doing that shit anymore. Some comments. Let's do this. Hey, Noah, I hope you are well. A very trivial question, and I'm sure you haven't, but was curious to know if you ever traded on smaller time frames for the triviality of it. Sure, but you got to use leverage, and you got to use, like perp exchanges, because you need the speed. Um, Make sure you use. I mean, you really still need a decent time horizon. If you're looking at a 5-minute chart, you still need the daily or the weekly because you want to find the trend. I mean, my mentality has such an inability to trade on like 5-minute charts. Because if you want to trade and get like a 1% move on Bitcoin and using 25x leverage, you can make a 25% gain, but I can't do it. I can't do it. Yes, I have done it. I have no interest in ever doing it again. I don't care if I make less money. What I care about is the methodology and my mentality and the story and what it means. Because can you imagine the story that we've told on this stream? The story that we're telling today, in 5 years from now, when instead of $65 billion on Ethereum mainnet, there's $2 trillion or $5 trillion. And you can imagine like the volume on like through dexes at $1 trillion a day, and there's a half a trillion dollars worth of liabilities that have been printed from S SFRAX and USDM and SDI and CRVUSD, and you can imagine when like instead of 200,000, $400,000 a week in fees for Curve, it's $50 million a week in fees. And I don't give a shit about trading in that environment. So I'm here for 2025, 6, 7, 2030. When instead of 300, 400 grand a week in fees, it's 50 million fees per week. And then I don't give a shit if it gets. So the max dilution you could have, the entire emission schedule of Curve is what, 50% from here? And that's if it's all locked, 100% of it. So that's not going to happen. And 50%. All right. So instead of making $1 million a week, you're making $500,000 a week. I don't know. That's the perspective and the time horizon that I have. Asarco. Oh no. KJV. Significance of yesterday's awful treasury auction. It means who the hell is going to buy the debt? And the Fed doesn't want to buy it, and the Fed surely doesn't want to hit the yield curve control narrative because then it's not a free market. So they still want a free market, but the whole world is hostile. The animosity is maxing right about now. What was it? Powell met with the central bank, China central bank. It was on the 12th. Was it yesterday or the day before? So I found that interesting. So at some point, existentiality trumps all politics. And I think we're getting to that point, like now between Q1, Q2, 2024, we're at the point of where they have to make existential decisions with regard to, financial markets. And they're going to want to juice the financial economy and not the real economy, because the real economy, that's how you got us into this damn situation. Those stupid stimmy checks and shutting down the economy. A bunch of idiots. So who's going to buy it? I mean, at some point, they can't issue it if no one's going to buy it. They can't issue it if the primary dealers can't absorb it, and the Fed clearly doesn't want to absorb it. Or is the Fed going to be forced to absorb it? I don't care about that silly narrative that the kids talk about. Oh, they're going to cut rates. Oh, the Fed's going to buy. Oh, the Jerome Powell printing. No, no. You know who prints? We print. We have printed. Us people, us individuals have printed the vast majority of dollars on the planet. That's what the euro-dollar market is. The government barely prints anything. There's only five and change trillion dollars on the planet. So we got into a situation by our own doing. There's $5.559 trillion dollars on the planet. But all of this money, 2008, you have to go back to the 50s? All of this money was already printed. All this does is deleverage the money that was already printed. You have to understand money in that regard. With the sustainability of the fiscal path, there's another story. Debt servicing and an actual balance sheet that works. But with regard to money, they lost control a long time ago. Yeah, I mean, there's a quadrillion dollars out there, and this all they did was deleverage it. That's all they do when they print base money. The problem is they have to manage the forces, and how do you get this money into the system such that it has a deleveraging effect without causing any capital to enter the real economy that causes consumer price inflationary pressures. Very complicated. Made it live. Hey Cap, doing nothing but claiming every 2 weeks, raising cash, and saying the right time horizon provides adequate comfort. That's what we've been doing, and obviously that cash the last month was pretty bad. Last month, albeit earlier this year, I think it was March. So last month's income was about March, but April, May, June, July, August, and August were really good. Of 23 of this year, they were really good revenue months. Very high revenue. Reminded me of like 2022. It's a lot of revenue in 2022. And I expect this month to actually be worse than last month, but we'll see. November and December might actually be decent. Maybe they'll be worse. And we'll have our real austerity. Finally, because 22 and 23 were really good years with regard to income. And then hopefully in Q1, Q2, 24, we finally get our turnaround. But it's a good perspective to have. Flex J, Noah, I heard in one of your previous streams you picked up some convex. What was your rationality for taking a convex position? Primarily Frax. Frax doesn't deploy capital at the base layer. They don't hit staked out a little bit, or vote market. They primarily send their capital to convex, and they have their primary ownership is CVX rather than CRV. VLCVX versus VECRV. So that was my rationale there. And historically, I've argued, and I still state, I'm mostly a base layer maxi. But shit, the Frax narrative is crazy. I have a high opinion of Frax, and I think it could be very big. So if they're going to deploy capital, they're going to deploy it to convex, and I want that money. So that's my rationality. Eris, do you believe that the the euro is better gauge of dollar strength compared to the DXY? No, just DXY is nice and average. It's right down the pipe. You want to see the real pressure, you look at the yen. I mean, literally, there is at the threshold. It's like the yen, just like right there. If it goes to 155, shit's gonna get crazy. So this is a crazy one to look at. I have the DXY, yen, euro, and the yuan up. Don't drive yourself mad. Generally, dollar down, risk assets up. Generally, I talked about the leads and the lags, but drive yourself nuts. We need more time, more information. And that's why I like to look at stuff like the 6-month chart. It's like, I mean, literally 6 months from now, it's just one candle on this chart. And look at where this triangular compression terminates in 9,314 days. Check back in 20 years for the termination of this. Like, if you see this break out, in the next like 3-4 years, 130, 140, a breakout from this perspective, the 6-month chart, this kind of time horizon, premature relative to the compression, that'd be pretty wild and scary. But clearly the end game is this is going way up. Now bear in mind we might see a bifurcation in oil prices. Like the U.S. is energy independent. We produce enough energy that we consume. I don't know if it's just pure oil. Maybe it's the whole composition. Um, but that would be an interesting world where you have, we're not buying any energy overseas, so the price of oil is just a different price domestically. That would be, I could see that kind of world. Sorry, last question. Did you go over your thoughts on Frax V3? Just joined. Pretty amazing to gain exposure to U.S. yields on chain. I think the potential for these types of proxies for T-bills and short duration assets is extraordinary. Why? Because they're basically a fungible, transactable, portable money market deposit. Oh, collateralizable. And the notion of collateralizing a money market deposit will kick the can with regard to fiscal complexities, and will allow significant expansion of dollar liabilities, systemic liquidity. I think it is underestimated what will happen in a positive sum environment with regard to these types of liquid money market deposits, because that's what you're talking about with SFRAX, SDI, so on and so forth. And what JP Morgan did with their private blockchain is literally a collateralizable money market deposit. That's crazy. Has leverage and capital expansion written all over it. Because why would you now you could literally, in theory, settle a transaction in a money market deposit, and you don't have to sell the money market deposit to buy cash. Holy crap. It kind of changes the entire equation with regard to global finance. What you're paying, if you want to pay for something in dollars, you either need like a bank account so you can do an ACH or a wire, or you need to buy physical dollars. Buy physical dollars, but now you have a new type of dollar asset that is a dollar or is redeemable for a dollar, so it is a dollar liability, but so it's a dollar that pays interest. It's a settlement dollar that pays interest. Settlement, yeah, because settlement could either be like a bank deposit, which doesn't really pay interest. So it's quite fascinating. It really changes a lot of things about how the capital flows and the plumbing work. So just high opinion there. All right, ladies and gentlemen, thank you very much for joining today. 18 people made it to the end of the stream. 12 likes. Hit that thumbs up button. I appreciate all of you. Friday, October 13th at 11:57 in the morning. Holy crap, we ended early today. Tell everyone to subscribe because we could all do a little bit better. In the description, link to the most rational community in the entire crypto space. I appreciate everyone who joined today. I appreciate everyone on Discord, and I appreciate us all trying to have a good weekend and surviving till Monday. See you then. Peace.